FY23 earnings press conference. We hope that you and your families are safe and in good health. I am Megha Kaul and I would be your host for today. Before we begin the conference, I would like to share some key instructions with you all. During today's conference, all attendees will be in listen-only mode. For the best experience, please select the stack and full screen view on the top right of your screens. If you have joined from your phone, you can double tap on the hashtag HCL Q1 window for a better visual experience. There will be a Q&A session at the end of the conference. In case you drop out, please rejoin us using the same invite link. If you experience any technical difficulties, you can message us using the Q&A panel. Today we have with us HCL Technologies Chief Executive Officer and Managing Director, Mr. C. Vijay Kumar, Chief Financial Officer, Mr. Prateek Agarwal, and Chief Human Resources Officer, Mr. Apparao BV. I would now like to hand over to Mr. C. Vijay Kumar. CVK, over to you.
Good evening, everyone, and thank you for joining us for HCL Technologies' first quarter earnings announcement. At HCL Technologies, we continue our journey with 5 key strategic objectives. First being leadership through differentiated products and services. 2, to become the employer of choice in our chosen markets. And the third objective is to be the preferred digital partner for Global 2000 enterprises in our chosen markets. The fourth objective is to weave ESG through our sustainability goals through ACT, PACT, and Impact. And of course, the fifth strategic objective is to achieve top quartile total shareholder returns over the medium term. I'm happy to share that we've started FY23 on a strong note with a healthy performance in Q1. Our revenue growth this quarter came in at 2.7% sequentially and 15.6% year on year in constant currency. Our services business continues to deliver increasing growth trajectory, growing at 19% year on year and 2.3% sequentially in constant currency. The growth momentum in our services business is led by our engineering and R&D services and our digital application services, with cloud transformation being a central theme across all the services and verticals. We also saw a strong recovery in our products and platform business, which grew 5.6% sequentially and 1.4% year on year in constant currency. When it comes to margins, we posted an EBIT performance of 17% this quarter. Margins in the services business is under pressure, mainly due to increased talent costs and transition costs. We have undertaken appropriate actions to improve our profitability profile, the results of which would start reflecting in the coming quarters. The margin improvement initiatives include both revenue and cost levers, led by innovative pricing, rate increases, and optimization of the operating costs, both people and non-people costs. From a segmental performance, our engineering and R&D services business led the charge with a 3.7% sequential growth, followed by our ITBS services at 2% sequential growth in constant currency. We are witnessing a number of end-to-end engineering services deals. We signed 2 large ones in this quarter, one with a European ISV and another one with a global ISV. Within the IT and business services, the growth was driven by digital application services, with the momentum in enterprise spending around customer experience, operating model, IT operating model transformation, and also through our cloud smart offerings, which have become a differentiator for us. We also signed several significant deals in cloud and other digital transformation areas. A large global European bank selected us for enabling its cloud transformation and overall hybrid cloud operations. One of the largest healthcare providers in the US selected us to help transform its infrastructure landscape by kickstarting the cloud journey. A Europe based leading global consumer goods and retail company selected us to deliver its future digital and IT roadmap through cloud migration, a digital workplace, and direct to consumer multi channel platform development. Starting this quarter, we are aligning our metrics disclosure to services and product businesses separately. In services business, we would be providing you the split for geographies and verticals. In terms of geographic growth, our growth was led by US at 2.8% sequentially in constant currency, followed by Europe, which posted 1.6% QOQ growth in constant currency. In terms of verticals, technology and services and telecom and media were our top performing vertical segments with 10.9% growth and 4.3% sequential growth in constant currency. Our life sciences and healthcare business grew 2.7% sequentially in constant currency. Talking about the bookings and pipeline, we again had a very strong booking this quarter, uh, crossing $2 billion dollars with 16 deals in products and services, 16 large deals across life sciences and healthcare, manufacturing, financial services, and technology segments. Our bookings grew 23.4% year on year, supported by a good mix of large and mid-sized deals. Our pipeline continues to remain at record high levels. It's well distributed across large deals and medium-sized deals. Moving to our corporate sustainability agenda, we are continuing our commitment to be net zero by 2040. Our GHG emission reduction targets for 2030 were validated by Science Based Target Initiative to be aligned to the 1.5-degree pathway. We are committed to develop products and services to enable our customers' sustainability journey. On this journey, we launched our first comprehensive sustainability focused solution called as Net Zero Intelligent Operations, NEO, which helps organizations collect real time data around energy consumption and analytics at scale to deliver actionable insights to our clients. We continue to see a strong momentum in the market. We remain very positive about our growth trajectory moving forward. We are very focused on profitable growth and in a manner that we can sustain industry leading performance. With this overall commentary, I'll ask Pratik to provide some next level of financial details.
Thank you, CVK. To give you the highlights from a financial point of view, starting with growth, 2.7% is the growth on a sequential basis, 15.6% year on year for the company as a whole. But obviously, the key highlight for the company is the services growth on a year on year basis, which came in at 19% in a constant currency basis. The P&P growth also was at 1.4% on a year-on-year basis, after excluding the impact of the divested CFT business that we let go last year, same quarter. The services growth driver was ERS, which grew at 23% year on year, but ITBS also grew at 18%, all very healthy growth numbers. P&P grew 5%, 5.1% on a sequential basis, which was also helping the services growth of 2.3% and moved the company total to 2.7 on a sequential basis. As far as rupee terms is concerned, the rupee revenue came in at 23,464 crores, which was up 16.9%, almost close to 17%. And EBITDA was at 21.2%, and profit after tax came in at 3,283 crores, which was 14% of revenue and 1.4% growth year on year in net income terms. With that, I move on to the booking performance, which was $2,2054 million to be precise, which was a good 23.4% growth. And even in ACV terms, it was a good growth of close to 18%. We also increased our customer numbers. 100 million customers went up by 3 numbers on a year-on-year basis, and $50 million customers went up by 5, again on a year-on-year basis. We generated $2 billion in the last 12 months in cash generation terms, operating cash flow, that is, and free cash flow came in at $1.76 billion, which is respectively 112% and 98% of our net income. And our balance sheet remains strong at gross cash of $2.25 billion. In shareholder terms, the last 12 months diluted EPS amounts to 50 rupees and 06 paise, 50 rupees round number, which is up by about 0.6% sequentially. And the board has approved a dividend of rupees 10 per share for the quarter, which will be, the record date will be July 20th, and the payout date would be August 2nd. With that, I'd like to hand over to Appa, our HR head.
Thanks, Pratik. Good evening, everyone. Hope you and your families and your near and dear ones are all keeping safe. As far as HCL employees are concerned, I'm glad to report that we have our employees are all safe along with their families, and our vaccination levels are at a very record level. And we don't see much of an impact of COVID. The active cases are very few. So we have a very healthy workforce with us as we speak. Coming to the talent segment, we added 1% headcount the quarter on quarter, which is around 2,089 employees. We are focusing on our utilization. We had a great year in recruitment. Our headcount last year grew 23.4%, and we are utilizing what we have hired in a better manner. And very heartening thing for us is our diversification in terms of geographies. Our new Vista locations, which are Madurai, Lucknow, Nagpur, and Vijayawada, our headcount grew by 30.5% year on year, which is very, very heartening for us, because our supply chains will get distributed, new talent markets we explore. And same is the case with our global new frontier countries also, which are Poland, Bulgaria, Romania, Portugal, Spain, Mexico, Guatemala, Brazil. There also our headcount grew to a healthy 30% compared to the previous year on year. And we crossed, in India, we crossed 20,000 people in our new Vista Center, and in new frontier countries, we crossed 18,000 people. This gives us a very good spread, both in terms of talent sourcing as well as any business continuity operations that are required. We added 6,023 freshers this quarter, which is almost 100% increase compared to the same quarter last year. And we are planning to onboard another 10,400 freshers in this JAS quarter. So, I mean, from training perspective, we spent 2 million hours this quarter, and almost 44,000 people got upskilled and deployed this year. And our internal fulfillment rate, because of training, both in generic skills as well as in niche skills, has increased significantly, and internal fulfillment rate is touching 50%, which is quite healthy. We will only concentrate more to increase these levels. Coming to attrition, we are definitely seeing an increased attrition. Last quarter, we ended up an LTM attrition of 21.9%, and this quarter it is 23.76, almost a 180 basis points increase. We still see heightened attrition, and next quarter also will remain more or less same. And we are seeing some green shoots in terms of attrition coming down, but not significantly. So we do hope in a quarter or two it will start stabilizing and coming down. So that's our expectation. Our return to office, employees coming to office still is limited to 12 to 15% levels. We are having employee connect programs in terms of looking to see how we enable them. But from a unique employees perspective, more than 50% people have visited our offices in the last 3 months. So that's a very heartening sign. We feel that employees would like to come back to some level. So we are pivoting towards a virtual hybrid model, and I think our efforts are in that direction. So with this commentary on HR, I'll pass it on to Megha for Q&A.
Thank you, Appa. We will now be opening the floor for questions and answers.
Thank you, Megha. Ladies and gentlemen, if you've joined us from the WebEx mobile app, please tap on the 3 dots on the floating panel on the bottom of your screen and then tap on the raise hand option. In case you are on your computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel and we will unmute your line. And in case you have joined on audio only, please press *3 to raise your hand. Our first question is from the line of Anisha. Anisha, I'm unmuting your line. Please go ahead. Anisha, can you hear us?
I can hear you. Can you hear me?
Yes, we can. Loud and clear. Please go ahead.
Hi, sorry. I'll take one question at a time. First, coming to you, CVK. I know you talked about how the services business continues to perform well, but purely from the point of growth rate, that seems to have slowed a tad bit because your services business grew in constant currency term at 2.3%. And if I remember it right, this number was 5% last quarter. I understand there would be a higher base as well, but just to get a sense in terms of how the demand momentum is looking like and what kind of growth rate we should expect for services going forward.
Yeah, so we have grown 2.3% after 3 consecutive quarter of 5% plus sequential growth in services. So to get a good perspective, you should look at a 19% year-on-year growth in constant currency. That would be the right metric to look at, and it's really a fantastic growth on the services business. Now, moving forward, while we don't give you a quarterly guidance, we've given a 12 to 14% guidance for the full year in constant currency. We are reasonably confident of achieving those numbers. And the booking this quarter has increased 23 plus percentage year on year compared to what it was last year. And the pipeline continues to look quite robust. So we foresee a good growth trajectory in the services business moving forward.
Sure. Point taken. Prateek, coming to you on the margin front, of course, this quarter, the overall sector is facing a lot of supply side issues, and that's similar for you. But what makes you confident of achieving that 18 to 20% range? And should we expect a bounce back in Q2 itself, or will it take time?
So, Anisha, I'll pass on your second question because, like CVK said, we do not give quarterly guidance. But coming to your first one, I think there are a range of metrics and levers that are available to us, both on the top line side as well as on the cost side. On the top line, we have already started seeing green shoots in terms of getting increases in various ways and methods from our customers. So that we are quite sure will speed up and get expedited over the next few quarters. Equally, on the cost side, the large number of freshers that we've taken over the last 5 quarters, including this quarter, that number is starting to become productive and billable. And that is the other big lever that we have, which is improving our pyramid and our average costs. And that, as it keeps on delivering, it will improve our margins going forward. Similarly, utilization and automation, more offshoring of the work, and so on and so forth. There are a number of levers that are available, which we are banking on to hit our at least the lower side of our range of margin guidance that we have given.
Sure, Pratik. I didn't mean to put you on a spot to give me a very quarterly, update in terms of margin guidance. But what I'm trying to understand is the bounce back going to be sharp, or is it going to be a slow and steady rise? That's my limited question.
I think it will be the latter, the slow and steady thing. I don't think anything is going to change drastically overnight.
Sure. Abhay, let me come to you and ask you about the hiring trend. This quarter, the number seems to be a tad bit lower, versus what you did last quarter. If I remember it right, last quarter, the net addition was around 11,000. This time, the net hiring is just 2,000 or 2,100 thereabouts. Now, given the fact we take headcount as one of the leading indicators of growth, should we be worried that there is a bit of a slowdown? And not a bit, actually, it's quite a bit, 2,100 versus 11,000.
Yeah, that's true. But you have to see on the backdrop of 23.4% headcount increase that has happened last year, and also 100% increase in freshers we have taken this quarter. So if you add up all these and connect the dots, it's not less.
So what will be the hiring target for the year in that case?
We don't have a visibility how much we will hire. We are sure about how many freshers we will take. So that will hover around 30,000, because this quarter we are taking 10,400. So it will be quite high in O&D also, and a tad low in JFM. And rest of it will be demand driven as well as the utilization driven for us.
Sure, I'll join back in the queue to allow others to ask as well. Thank you.
Thank you, Anisha. Our next question is from the line of Romita. Romita, we are unmuting your line. Please go ahead.
Hi.
Hi.
Hello.
Hi, we can hear you. Go ahead.
Yeah, hi. I think I would just like to build upon Anisha's query that, in terms of fresher intake, you had in the previous quarter mentioned that you expected around 35,000 freshers this fiscal. You just mentioned it will be around 30,000. I'm just trying to understand if you have kind of realigned the guidance for freshers. That is one. And also, overall, do you expect some kind of normalization in the hiring requirements this year, this entire fiscal?
No, we have not lowered the guidance as far as freshers are concerned. I mean, in fact, we are ready to recruit more. It is business driven. We are currently definitely targeting anywhere between 30 to 35,000. We have not lowered that part.
Got it. A query for CVK would be, sequentially retail and manufacturing are a tad bit down. Can you, explain what has happened over there? Also, just in general, with respect to long-term transformation projects, or just generally with your clients, what is the demand situation like? Do you see clients having any kind of, concerns or queries about an impending slowdown in the market?
Yeah, Romita, I think if you look at our year-on-year growth in verticals like technology, it's over 30%, telecom, media, entertainment is close to 30%. life sciences and healthcare is 15%. So across all verticals, barring retail CPG, we've had some excellent growth metrics on a year-on-year basis, and mostly sequentially as well. But in some verticals, there will be project completions and some one-time work which would have got completed. So that will have some impact in the revenue numbers, growth numbers. And we expect to see a good positive trajectory moving forward, even though there is concerns on slowdown. Our pipeline continues to be at an all-time high. There may be some small projects here and there which may get deferred, or there may be some delays. But structurally, I do believe the trend is intact. The customers are looking for transformation programs or continuing their transformation programs. There is a little more heightened emphasis on cost takeout kind of programs. And HCL has a pretty robust portfolio of change the business and run the business across both products and services. So I think we are well positioned to do well in the market, which is growing, where there's be a lot of digital transformation spend. And if the market is a little challenging, we do think a lot of run the business type of transformation which will come our way.
Understood. Just one last query, if I may step that in, would be purely on the products and platforms business. What is the outlook like for the fiscal?
Yeah, we don't give any segment specific forecasts. Overall, we have given a 12 to 14% organic growth in constant currency, and we will stay with that.
Thank you. Thank you.
Thank you, Ramita. Our next question is from the line of Nallur Sethuraman. Nallur, we are unmuting your line. Please go ahead.
Good evening, gentlemen. So I just wanted to know, so the net hiring dropped this quarter. So does it actually show that any kind of moderation in terms of the deals, or like are you seeing any kind of slowdown in terms of client spending, or the overall macro environment seems to be slightly challenging? So I would also like to know more about your commentary about like how that would impact HCL over the next few quarters. Thank you.
Yeah, I think net hiring numbers also have to be looked at from a year-on-year perspective. We've been hiring a lot in the last 3-4 quarters prior to this quarter. And even in this quarter, we hired a significant number of freshers, while net addition is 2,000 plus people. I think the freshers are all trained and they're already deployed, and we have some additional capacity which we can utilize to continue to grow. So it's always a balancing act between how much capacity that you build up to deliver growth. And we continue to remain very positive on the 12 to 14% guidance that we've given. So whatever is required for that, we've already hired. And this quarter, again, we expect to have robust hiring.
Sir, on the macro environment and the client spending?
Yes, of course, there are most of the verticals, we do not see any concern, and they continue to look at their transformation programs as being mission critical, and they're continuing to walk the path in expanding or even completing programs. But there are some pockets in manufacturing and maybe retail CPG. We are seeing some projects which are getting delayed. But in the larger scheme of overall portfolio and the service mix and the vertical and geography mix, as I said, our pipeline is at an all-time high, very near to an all-time high. So I think we don't see that to be a factor that will impact us. So far, we haven't heard much. We continue to remain very vigilant to see what's happening in the environment, how it will impact us, how we can help our customers. All of that remains very central to our strategy.
So the delay you mentioned is about the client spending or the execution of the projects?
No, nothing really significant to call out. It's just some small projects here and there could be delayed, but in the larger scheme of things, I think the trend is intact.
Thank you, Nalo. Yeah, we'll just move to the next person. And you can email us questions in case you have any follow-up questions. Our next question is from the line of Surbi. Surbi, I'm unmuting your line. Please go ahead.
To ask you that, as far as the environment is concerned, we've heard from some of your peers as well as there's some concerns about the inflation in the US, which is the largest market for you and other companies. So what is HCL's experience like? Are you also experiencing some sort of stress from the clients, which may lead to some kind of a slowdown in spending or deal cancellations?
See, I think you know as much as what we know, and then the incremental data points from our clients is really, if I want to look at it very objectively, it's reflected in our pipeline. So while there is inflation, while there is a little more focus on costs and customers preparing for a slightly higher inflation environment, but they continue to have programs which helps them to be viable either by cost optimization or continuing to drive transformation, while transformation helps in customer experience and supply chain management, new initiatives around omni-channel and things like that. But it also is one of the central themes to really reduce the overall operating cost. So I think technology will continue to be a very, very important tool customers will use in a high inflation environment.
Thank you, Surbi. Our next question is from the line of Jatin. Jatin, unmuting your line. Please go ahead.
April, June, you can confirm that, and what's the plan for July, September?
Sorry, what plan are you asking about?
Fresher addition number for April, June, and how much you plan to add in July, September?
So we added, as I mentioned, 6,023 in AMJ, and we are targeting 10,400 in JAS.
Okay. One more thing on, can you please also give us how much consumers you've added sequentially in April, June?
I think it's there in our IR release. We have pretty healthy client additions across all the categories. I don't have specific numbers.
100 million, we added one client, 20 million plus, we added 9 clients, and so on and so forth. I think it was 15 for 10 million plus. It's there in the release. These are the highlights.
Okay. One more thing on the attrition part. Since HCL had said like in the previous quarter, it expects it to come down, but like we've been talking, it has actually gone up. And so how many quarters you see it will remain? I've given that your peer TCS has also said it could remain high going forward.
So we do expect attrition to remain at same level or marginally lower in this quarter. But post that, we have some green shoots we are seeing that it possibly will start declining because this is that's the data what we have currently.
If I may add, I think APA is talking about quarterly annualized attrition, which we look at internally, which is what he's talking about is kind of plateaued or peaked, rather is the word he used. But the last 12-month attrition, which is what we publish, which is at 23.8%, might go up a little bit more next quarter because it is the last 4 quarters every time. It's a moving number for last 12 months.
We just have time left for maybe just a couple of questions. So, Uma and Debangana, I will be unmuting your line and requesting you to please restrict yourself to one question and follow-ups on an email. So, I'm unmuting Uma's line right now. Uma, over to you.
Am I audible?
Yes, you are.
Okay, thank you. So my question is also kind of follow up on attrition, considering the present supply side challenges. Are you planning to increase the salary hike? If so, what percentage, what range it will be?
So our salary increases are effective 1st July. We are not in the April quarter. So we are discussing internally in terms of what should be done. We will come back to you in the next few weeks.
Okay, thank you.
Thank you, Uma. I'm unmuting the line of Debangana now. Debangana, over to you.
Numbers. Last quarter, CVK sir had mentioned about the outsourcing a lot of hiring in what they call the global new frontier locations, which included Sri Lanka, Vietnam, Brazil, Mexico, and so on. So would like to know more about what's the hiring target, or is there a plan on hiring on outsourcing from other countries for this fiscal? What is it? And also within India, we have started seeing that a lot of startups are laying off. So now nearly more than 30,000 people have been laid off. So has this sort of eased the supply a bit for IT companies, for tech talent?
So your first part of your question, I mean, we do leverage some partners in non-English speaking countries. To a large extent, we try to hire directly using our own colleagues, recruiting colleagues. When the demand is very high, we have kind of relaxed it a little bit, even in English-speaking countries, but we have our controls back. We are definitely looking at talent being available more easily in the market as compared to the previous 2 quarters. So, I mean, 13,000 as a number in Indian context, given the size of IT industry, is a drop in the ocean. But generally, it has. I mean, all organizations started training their manpower. A lot of freshers who have been recruited in the last year and a half, they were productive now. I think the supply side is gearing up to meet the demand.
Right.
Thank you, Appa.
A quick follow-up to that, if I could ask. Last quarter, the company had said that it is investing heavily on talent model transformation, which is in a way impacting the operating margins. So could you share a range or a number on how much has been invested in trainee hiring, and like sir also mentioned about the upskilling of talent this quarter, trainee hiring, talent upskilling, and so on?
Yeah. So I mentioned one metric, which is internal fulfillment, right? I mean, that comes purely out of the training that we provide to our people. That internal fulfillment has touched 50%, which is quite high. If I have 100 requirements, demands that are coming out, 50 are getting fulfilled through internal training. That's the investment we are doing in training, which is almost every year 30 to 40% that training hours are increasing. So, which is a very healthy sign for us. I mean, that will help us in meeting the demand without really escalating the costs.
Thank you, Appa. That was the last question of the day. Over to you, Megha.
There are no more questions on the line. Thank you for your questions. Thank you, everyone, for your valuable time and presence. Please note, the recording of this webcast will be available on the HCL Technologies website. With that, we conclude this press conference. Thank you once again for joining us. Stay safe and take care.